Hey everybody, John King. Thank you so much for joining me. It is our Financial Friday live every single Friday, 12 noon. I come to you with a different topic, a different conversation, really with the goal of helping you to improve your finances. Maybe it's about mortgage related things. Maybe it's about just life and finances and money. And today is an amazing show about exactly that. It's about life and finances and money. So before I introduce my special guest, I just want to remind you, continue to come every single week, share this with everybody that you know, subscribe to my YouTube channel, and let me give you a brief video introduction to what exactly my Facebook Friday, my financial, what the heck is it called? Financial Friday is all about. Here we go. Wasn't that exciting? I feel like I'm like a real TV star because I have a little commercial intro with music and dancers. Okay, maybe I'm the dancer. Anyway, enough about me. Today, I want to talk about what my show is about. This show is about estate planning. And I call it Estate Planning 101 because we're really going to start at the basics of what estate planning is all about. And I'm super excited to invite my special guest in here today. So I want to welcome Dianna Wilke. Dianna, welcome to, hold on, we still have you muted, Dianna. Let's unmute you here. All right, perfect. Technical difficulties. Dianna, welcome.
Thank you. Pleasure.
Appreciate it. So audio's good, video's good. We got all set. We both of us had a little bit of technical difficulties before this show, but we got it launched on time, and that's all that matters, right?
Yep.
Exactly. So Dianna, if you wouldn't mind, give me the 2-minute, 1-minute, 10-minute version. Who are you? What's your background? What do you do? And what makes you credible to talk to us about estate planning today?
Well, I'm an estate planning attorney. I've been an attorney for 25 years. 9 of those was working with a major financial institution where I did planning for all sorts of clients and then ran an investment management and trust division as well. So I've done a lot, but the bulk of my career has been doing estate planning directly with clients. I am a certified specialist by the state bar. Which means that after I took the bar exam and practiced 5 years, I took another exam in estate planning and I recertify every 5 years for that. And then I also have an advanced law degree in estate planning and another one in taxation. So
love it. All right. So is that common? Like what you just described? Hey, Anna, can we get rid of the banner? It's wonderful that we can know everything about Dianna, but it's hiding half of her face. How many, I pick up the phone, I call my best friend and say, hey, who did you use for your estate plan? Who should I talk to? All those credentials you just talked about, that's normal. Like everybody has those. Yeah.
No. So there's about 200,000 lawyers, give or take. And then there's a much smaller amount, maybe shy of 1,000. I'm not actually sure, but it's low. Of estate planning specialists in the state. And it's very, it's monitored. You have to have so much continuing ed. You have to have recommendations, and it's a pretty rigorous process to get in and then stay in. So, and then those degrees, everybody's pretty much done with school when they leave law school. So that's not a lot of people get those, but I like
glutton for punishments. Mm-hmm. I gotcha. So you said there was a degree also in taxation. What was the exact title?
Master's of Law LLM. So I have a Master's of Law LLM in estate planning from University of Miami, and a Master's of Law LLM in taxation from University of Alabama. Roll Tide.
And Roll Tide. I know. So why is that just kind of like, hey, I have a major in economics and a minor in underwater basket weaving? Like, why is taxation important when it comes to estate planning?
For a number of reasons. Estate planning encompasses a number of taxation, estate taxes, gift taxes, transfer tax, just transfer taxes in general are a key element of it. And then additionally, when you're doing different transactions, you may impact the client's taxation picture. And you also have to look at the taxation for beneficiaries in the future. And so that knowledge is really key in making sure that your plans do what they need to do. So.
Got it. All right. I'm going to start with a softball question. And this one I don't think was on our list. If it's on our list, it's way down and I forgot that it's there. But you just reminded me of a question I get all the time. So I want this as a freebie because this is extra. Okay. And that is, people say, oh my gosh, John, my grandpa's willing to give me a gift, but it's over the limit. The IRS only lets me give me so much money per year. And so I can't, like, I don't have an option because we're in trouble if we give over that limit.
No,
and I know that's not about estate planning, but could you cover that one for me?
It actually is. It actually is. So everybody has at this moment around a $12.9 million lifetime exemption and estate tax exemption to give away. So if grandpa went over his annual exclusion amount,
yes.
A, you don't pay any income taxes because there's no income taxation on gifts. And B, grandpa is just dipping into his $12.9 million exemption. So there's no taxes due on his side either. So it's
as long as grandpa doesn't give more than 12.9 million. And I it sounded like that number is variable because you said today. So I'll ask about that in a second.
Yeah.
But let's pretend that number was fixed for a moment. As long as grandpa didn't exceed his 12.9 million lifetime gift giving in excess of the annual, that's the only time grandpa's going to have a problem having given you gifts while he was alive.
That's correct.
Okay. So what controls that $12.9 million? By the way, I mean, most of my customers have well over $12.9 million to worry about distributing.
Right there.
Yeah, everybody's, I mean, do I have 13 million in assets or 12.8?
And that's per person. So if you're married, it's double that.
Oh, well then because of that, we're all covered. Like it was my average grandparent has, 10 to 15 million in assets. You all have grandparents with that much, right?
Yeah.
So for the record, my wife and I say all the time, we were born into the wrong family. Like, I don't know what we have an amazing family and we won the parent lottery and the family lottery and all that kind of thing, but not the financial one. Like we just missed out on that family lottery thing. Okay. So continuing that side note really quick, why does that $12.9 million cap change? And I mean, will it ever drop to 500,000? Because that's a real number that says, oh man, grandma and grandpa might have 500,000 they're going to give, and now they're in trouble.
The answer is it could, but I very highly doubt that. The exemption amount, and there is actually a law that was passed, and the IRS has said that if the exemption goes down in the future, they're not going to go back and tax people who've given away more than their future exemption, so that you're protected there. But the Congress, when they enact new tax laws, they move that number around. And right now, they passed it in 2016. And it sunsets after 10 years. So it'll go back to what it was before, which is around 5.8 million. So
again, let's be honest, the average person doesn't have almost $6 million to give in assets. So this is a protection against the super wealthy, and it's understandable. And by the way, I'm going to make this comment, and I'm sure Dianna is going to agree with me 100%. A lot of what we talk about here with taxation, with law, it can be political. This is not a political conversation. There's, hey, this administration did this and this administration did that. This is simply about factually planning your future. Yes?
Yeah, absolutely. And I do want to say, again, not a political comment, but estate tax is actually very, very good for the majority of Americans. And that's because what happens when somebody dies is that everything that they own, with some exceptions, steps up to full fair market value on the date they die. Which is why I shook my head initially when you said grandpa wants to give me something, because sometimes that's not good for this reason. Because if you bought a house for $100,000 and the day you die, it's worth $500,000, your children or whoever your beneficiaries are will take that house at the higher tax basis, and they will not pay capital gains tax if they sell it.
Got it. And so let's go down that road. This is, again, I want to take this conversation wherever it goes. I've got a basic outline of things we want to cover, but when we think about step up in basis, I'm gonna convert this into a simpler way of thinking about it. When you buy something, that's what your cost was. Yes. When you sell it, if it's an appreciating asset, which homes typically are, as an example, hopefully. By the way, I've got some great videos on my YouTube channel, releasing another one today that talks about my thoughts of where housing prices are going to go. Shameless plug for my YouTube channel. So that hopefully comments. Perfect. Thank you, Dianna. So the house price increases. You bought it for $100,000. You sell it for $500,000. The IRS says, okay, you've got $400,000 in gain. And there's rules, and we're not going to get into those rules, but it has to do with, was it your primary home or not? How married couple or not? How long have you had it as your primary? You may or may not pay taxes on that $400,000 of gain.
Right.
But what you're describing says, but when you pass away, if you still own that home, then instead of treating the purchase price like 400, the IRS raises your cost, your purchase price, to what the house is worth today. If the kids sell it today, the heirs, beneficiaries, they get whatever profit, whatever that has grown, they're not taxed on because the basis was brought up. If they wait 10 years to sell and it goes up even further, you're only paying taxes on what it went up from today, which you may not pay any taxes because there's exclusion rules. But the bottom line is that's essentially what a step up in basis means. Did I say that correctly?
Yes, you did. And the other thing about the basis step up is if it's a rental property, the depreciation base starts all over again too.
Oh, that's awesome. So that is estate planning 102. Yeah. I'm not sure we're going to get to that.
No, but I'm just saying there's a lot of benefits to it. So
yes, but it does answer the basic question I was going to ask you, which is, does this apply to, and you said pretty much all of my assets. Are there any big ones that say it doesn't apply here or there that you can think of?
The biggest is retirement. It's what we call income in respect of a decedent. If a decedent, the person who died, would have to pay income tax on an asset, generally speaking, it will not get a basis step up, which means if the person who died was going to have to pay income taxes on their retirement plan, the beneficiaries are going to as well. So that does not get a basis step up. But generally speaking, everything else does.
Love it. Perfect. All right. Well, that is a good intro into this conversation. By the way, we've got a handful of people on this right now. If you're watching live, please post comments. Just let me know you're listening and not sleeping behind the wheel as you're watching. So just say hi if you want to. If you have a question you want to make sure we answer, we are going to make this as interactive as possible. If you're watching recorded, thank you. Appreciate it. Share this with your friends. Hopefully it was shared with you. Post comments anyway, because I'll be watching the comments regularly. If it's a question that I need Dianna's assistance on, I will ask her for her advice, or her contact information has popped up a few times. I mysteriously think it'll pop up here in the next 30 seconds, probably, since I just said that. So you're able to reach out to her directly. To be perfectly clear, Dianna is a for-profit organization, and I don't mean that in any negative way. We all are. So, there's a certain point at which we're providing a service and educating you. And then there's a certain point where you're asking for specific advice. And Dianna is available to be hired to give you specific advice. And you and I didn't talk about this ahead of time, but I certainly don't want people thinking they can just call you and get all their answers to questions they didn't ask today. Fair statement? Okay. So bottom line, if you have questions, post them now because you get your answers for free. Hey, what do you know? All right, so let's go ahead and start out with, isn't estate planning for rich people? Like, we just talked about that. We literally just spent the first 10 minutes of this conversation, and we talked about the fact that, hey, estate planning, this whole, gift tax and all this kind of thing, that kicks in when you're over $13 million in assets. I don't have that much in assets, so I don't need an estate plan, do I?
The answer is it depends. That's always
Fair.
the answer. It depends. If you have minor children, you definitely want to plan because you have some control and some guidance for them as they grow up. If you own a home in California, you definitely want to plan. And that's because it'll avoid probate. And there's some ways that you can get around it, but they're never good outcomes. They're very rarely good outcomes. Okay. Like what we talked about with grandpa giving away the house. That is sometimes not preferable because you don't get that basis step up if you make a gift. That doesn't happen. And also, if you were sued and you own grandpa's home, they could take grandpa's home. And so I'm never really a big fan of that for those reasons. There are some exceptions, but generally no. So yes, estate plans can help rich people, but the bulk of my clients are not taxable. The bulk of my clients are families that are normal and have normal assets and, want to, have kids or don't have kids, but they want it to go to the people they want it to, and they want to have some sort of plan and control as to how that happens.
I love it. You just answered one of my later questions, and I'll bring it up right now just to repeat it. So, a lot of people say that, well, I don't need an estate plan because I can just add every bit of my assets now. I can put my kids on my bank statements, or my bank accounts. I can put my kids on as a co-owner of my home. And I know you just said it, but if you repeat the short version, why is that a bad idea?
If you ever were sued or had some sort of issue, they could and you got sued, they could take the home. That's a big one. And also, depending on how the gift was made, you may not get that step up in basis when your parent dies. So it's twofold question.
Got it. Perfect. And there's mortgage planning thoughts here too. Now, this is about estate planning, but there's definitely pieces to, hey, is it a good idea to have them on the mortgage or not? And are you buying it or refinancing it? And there's some times when that's the only way we can make it work. Absolutely. And so you always have to weigh your risks and your cost benefit, right? So, well, Dianna said, don't do it, John. And now you're telling me to do it. Well, it's because otherwise you guys are going to lose the home to foreclosure or whatever. So you got to balance that. You agree?
Absolutely. No, there's times when the clients, say this is a situation. I'm like, that's what you need to do. And particularly if you're not going to sell it, it's going to be your home. Yep. It doesn't really, it doesn't matter. So.
Exactly. All right. I'm going to jump to one of our questions. So again, guys, I'm okay with whatever the question is. If I think we're going to cover it later, I may postpone it. This is one we're not going to cover later. But Grant asked a question and he said, I have a disabled adult son and I need to establish a conservatorship. What are some of the basics I need to know? And what is the standard fee to establish a conservatorship?
So I am an estate planning attorney and I'm a specialist, but I don't do conservatorships. That's kind of a special subset. But that said, it's a court process. You file paperwork with the court. You hire an attorney. I think you can do it without an attorney, but I recommend doing it. Makes it a lot quicker, a lot smoother. And they usually charge hourly, but that depends on the attorney that you work with. But I recommend looking through the bar, looking for somebody who does conservatorships and just talking to them and working through that plan.
Got it. Without saying it publicly right now, are there people you specifically recommend when you're talking to your clients about it, or is this something you kind of say, hey, that's something you need to research on your own?
No, I send out referrals regularly if that comes up. So
got it. Beautiful. All right. One more question that just came up. Tammy said, what if you had them added as a beneficiary of the bank accounts rather than putting it in an estate trust? So let me let you try and tackle that question. We might ask Tammy for some clarification.
One thing, it will avoid probate. If you have a beneficiary on there, it will avoid probate, which is why people do it. Or sometimes they put somebody on the account so that for final arrangements, they don't have to worry about having access to the money right away because they're already on it. Downsides of it are, one, if that person passes away, which I have right now, the beneficiary actually passed away. And now we have to figure out it's going to go through probate. So because there's no beneficiary listed. So there's that. The other thing is if the money goes directly to the beneficiary and you have other assets that have costs associated with them, then you have no money in the estate to deal with those costs. And then you have to go try and track it down from the beneficiaries. It's better to put everything into a pot, which is basically what a trust is, and then utilize the monies to pay off things and then go ahead from there to distribute the money however you want it to go. So.
Love it. Thank you. All right, let's get back to our regular scheduled programming. All right, so this is really, again, we're starting with Estate Planning 101. You talked about this a little bit. You said, and I'm going to shorten this up because we have a lot more things we want to cover. At what life stage should somebody consider an estate plan? And you really said, look, if you have significant assets, but otherwise it's really when you own property in the state of California, that's a critical moment. And you said when you have children and you want to be able to care for your children and designate, hey, who gets the care? Where does, I have life insurance money, but I don't want that to go to grandma and the care for the kids go to auntie and uncle. And now auntie and uncle have to fight with grandma to get money to pay for the kids. And the trust works through that, right?
Yes. And also if you have beneficiaries, if you don't have a plan, so whenever I, do talks about estate planning, my lead-in question is how many people here have an estate plan? And, maybe 50% of the people raise their hand. And I said, actually, that's a trick question. 100% of you have an estate plan. It's just whether or not you opt into the plan. And
Yes.
so if you have a plan that's different than what the state of California has said your plan is, then you want to plan because it's not
Yes.
going to go the way you want it to go to. So
I got it. I love that. So you, again, I think we just handled this, but what happens if I pass without an estate plan in place? You literally just said it. There is a plan, and that plan is probates, right?
And well, you go through probate in two situations. One, if you have no plan, because the probate process will dictate who the beneficiaries are. But you also go through probate if you do not have a trust and you just have a will. So probate is the process where, and I'm jumping ahead, but I need to talk about it to explain this.
Yep.
So a trust is a living and breathing document that you sign when you're alive. And it's basically a bucket that you put your stuff in. That's all that is. What happens is when you die, you're holding the bucket while you're alive. And when you die, you hand the bucket over to the person you've designated as the next in charge. But it's already living and breathing. So the court doesn't have to be involved. Nobody has to come in and say, these are the rules. These are the things you have to do, because the document and of the trust says all those things. And it says who's in charge and what they need to do.
Okay.
If you have a will, it is not a valid legal it's not a legal binding document until the court says it's real. It's valid. It was signed properly. You met all the requirements. The court will say, yes, this is a good will. It is now admitted to probate, and you now need to follow the rules of the court. So that is how they're different. So you go through the probate process, and in a will, you have beneficiaries that you've designated. When you don't have a will, then the beneficiaries are designated by the California Probate Code.
Got it. Well, you did beautifully, because you said you jumped ahead, but I actually kept my banners going right along with you. You filled in perfectly. We're doing great. It's like we
all work together. That's why I'm like,
It does.
Yeah.
So you started talking about this, but we didn't get there. So let's go. I think the next comment. Well, okay. So I have a trust, and I got a bucket, and that bucket goes to somebody else. That's my plan.
Yep.
Or I have a will. The will says what to do, but the state has to make the will enforceable through probate.
Yep.
Okay. It's still going to happen the way I want it to happen. So what's the big deal about probate?
So I filed a probate in February. My hearing to open it to where the person can start acting is not till August. It took 6 months to get a court date to open it. And then it's going to be about 9 months to a year to close it. So we're talking 18 months. Now, I know COVID's impacted the courts, but it's usually about a year-ish from open to close. If the courts are on the ball, it could be about 6 months to 8 months to do a probate.
So how do I pay for the funeral? How do I pay for the kids to continue having clothes in the meantime? I mean, is that the problem, or is there an interim solution?
So there are some distributions that can be made during probate, but you have to get court permission to make that happen. And until the probate opens, you're paying for it all yourself until you can get it opened and get the access to the money. Whereas with a trust, again, it's a living and breathing document. So really, once you get that death certificate to say the person passed and you're now the trustee, and there's ways to get around that too, then you have full access to everything and you can take care of all those assets. And usually a trust administration, easy one, takes about 4 months because there's a 120-day period we have to wait. Long end, it's about a year. And that's but most of the assets are distributed out before then. It's just we have to close up, file taxes, do the things that we need to do to close it down.
Got it. So that's actually not the reason I expected you to say, which is why you are the expert. You have all of the degrees. That's why I'm not posting this and answering the questions. I don't give legal advice. I'm not an attorney.
You're talking about money
on TV. It's money. It's money. It's always been, you want to avoid probate because of money.
Well,
am I wrong?
So there's a myth to that. So It is expensive to go through probate because there are statutory fees that the attorneys and the executors are entitled to under the code.
Okay.
And it's a percentage of assets.
Okay.
Generally speaking, a trust will avoid the large amount of attorney's fees that are associated with probate. Generally speaking. Now, there might be complex situations where that's not the case, but generally the answer is yes. And so, but there's no fee to the state. Everyone's like, oh, I don't want the state to get my money. And that's a myth. The state doesn't get your money. The money doesn't go to the court. The court gets maybe $2,000, by all in. The rest of it is paid to the attorneys and to the executor. But attorneys don't like probate either. So because we don't get paid till the end. So there's that. So you got to wait a year and a half to get paid. But more importantly, I don't like what it does to the family. Okay. It's just a drag.
Yeah. Well, the fact that you said that the money doesn't go to the state or anybody else doesn't make me feel any better. Now, understanding I'm talking to an attorney, but the fact that the attorney's getting the money, I don't know that makes anybody feel any better.
I totally agree. And they're the first ones to get paid. So if they use all the money, they use all the money. But it's a lot of work to go through the probate, and you can do a probate on your own. You don't need an attorney, but it is not as smooth as it could be if you had one. So
I don't know that we addressed this later in the outline or not, but I'll ask it now. Isn't there like a streamlined probate? Isn't there a easy probate? There's something.
Yes.
There's something there. Help me understand that.
So if you have under $166,250, you can go through what's called an affidavit process, where you file an affidavit with the bank, you file an affidavit with the financial institutions. It's much trickier with real property. And when they're looking at the value of the estate and figuring out the $166,250, they're not looking at the net of debt. They're looking at the gross value of the estate. So if you have a house and you only have $20,000 equity and you think, oh, I'm under that amount. No, you're not. You're actually, it's the value of the house. So
I'm going to say that in a different way. I'm going to repeat exactly what you said, almost in the same way. If the sales price of the home is over the $166,000, I can't believe you memorized that exact number. I'm going to call it 170 grand. Okay. So if the price is over 170,000 as a sales price, or your house sells for 150, but you got a $20,000 truck in the backyard that you're selling as well, that's sales price of over that 166-ish number. Therefore, you can't do the quick affidavit mini probate version.
And you actually still have to go to court if the real property is over 50,000. So there's a special real properties kind of segregated out. Okay. So I always tell people to put their bank accounts in the trust and things like that, because if one thing sucks you into probate and those bank accounts are out there floating around, they're going to get sucked into. So you want to make sure you get everything into the trust if you have a trust, and that will avoid probate. So
love it. So I'm going to pause for a quick second. I didn't prep you for this question, and I hope that it doesn't catch you too far by surprise. There's a lot of different people you can go to get an estate plan. There you can go to a legal document specialist who's licensed and prepares the documents specifically for you, but can't give you advice. I'm correct on that. Then there's an attorney that doesn't have your level of credentials. How does somebody decide, hey, John, I heard you talking to Dianna and I want to give her a call. I want Dianna to prepare my trust. And I'm sure that you would happily help anybody out, but I'm sure you also, just like anybody in any industry, your credentials, your experience, your level of knowledge is best suited sometimes for particular circumstances, and that somebody just doesn't need your level of service and can get by with something simpler. Can you answer that question? What's the right person for you? Or how does somebody decide? That's a better question. How does somebody decide? Do I call the best of the best because I need them, which Dianna is the best of the best? Or am I okay with just the guy that offers a $500 trust on the Yellow Pages?
So I reviewed one of those trusts yesterday. There's no provisions for how the property gets distributed. It never goes anywhere. The thing you have to worry about is what level of software they're using. Is it updated regularly, or is it something they bought off the shelf that was, a few $100s and they use it forever? Do they, how do they go through continuing education? Are they looking at the laws, differently? Do they seek more education? That's a huge thing. The thing I always say is I stay in my lane. Being an estate planner is one of the easiest things that somebody can pick up as a lawyer, because you buy a software program, you sit in front of a computer, you answer a bunch of questions, and a document spits out.
Yeah.
You don't know
mortgages, right? You push button, get mortgage. Anybody can do it.
Well, that's the thing. Every question that you answer has a consequence to it. And, when I mentored people in the past, they'll tell me it says this. And I'm like, yeah, that's because you picked this button three questions ago and it triggered all this other stuff that you don't want. This is bad. So you want to find out what kind of software they have, how often they update it, and whether or not they, converse with other people, and also what other areas of law do they practice. Because just like you don't go to a heart surgeon to get your knee replaced, you don't want to go to an attorney that does something differently all the time to take care of your estate plan.
Is there anybody that shouldn't call you? Is there anybody? Because first of all, I would love everybody watching now, everybody that watches in the future, call you. You're amazing at what you do. Is there a point that says, hey, call me, and if I'm not the right person for you, I'll tell you? But otherwise,
I do that. Yes. So like conservatorships, I don't do those. I don't do Medi-Cal planning. Giving your.
I had a show 4 weeks ago about a guy that does Medi-Cal planning, does an amazing job. Go back to that show.
Yeah, exactly. So you want to go to somebody that's what they do. I've chose not to specialize in those areas because you have to pick and choose kind of what you're going to focus on. But I help a lot of young families. I have clients that are worth several $100 million, and I do kind of everything in the middle. And, it just depends, but truly you want to find out what level of education they have, how long they've been doing it, and what software they're using, because that is really key. And again, if they're doing other things besides planning, and I'm not talking bad about people who do a couple different things, but if you're doing, one area of law and then you're kind of dabbling over here, maybe not the best fit. So
I gotcha. All right, let's dive into a couple of the questions. First of all, I'll bring up a comment just because it's self-serving, and I'm okay being self-serving, right? Tariq, thanks for the comment. I appreciate that, guys. You want to give me props for doing these? I would love it. I'll show your name on the screen. So thanks, Tariq. Andrew has a real question though. Andrew said, what assets can and can't be put into a trust? And do I need to own them free and clear in order to put them into the trust?
So, you cannot put retirement plans into a trust. And that's because your retirement plans will have a beneficiary designation on them. If you are married, it generally will be your spouse first. And then if you have minor children, the trust will be the contingent beneficiaries. And that's because I don't have time to get into it right now, but trusts and retirement plans sometimes fight a little bit for tax purposes. And so, you don't want to use it for that very often. And then also sometimes life insurance policies do not get owned by the trust, but they are payable to the trust. I recommend strongly let life insurance get paid into your trust, absent extenuating circumstances, because one of my very first cases was a husband and wife. They were in an accident. Husband died initially. Wife survived. She put in a claim for the life insurance policy, and she died 6 weeks later from complications from the accident. And it forced a probate in wife's estate because they had already issued the check and it was on the way. So now the wife had a check for $2 million and we had to probate it. So if you name the trust as beneficiary, whoever's alive in that pot, in that bucket, and your beneficiaries, they will get the money.
It goes into the pot.
And then free and clear, no, you don't. But if it's a commercial or if it's rental, you want to check with your mortgage broker to make sure that you are able to put it into your trust. And generally, you'll have to get an endorsement or an addition to the mortgage in order to make that happen. But they can prevent you from putting your home in.
Okay. Beautiful. So a couple of housekeeping items. First of all, I think, Dianna, I caught you by surprise when I disappeared, but don't worry, everything was fine. I took myself off because I needed to take a drink of water, but I saw your face go like this, like, oh my God, did we just shut down?
Well, I actually thought maybe I dropped.
Right. Well, you did great just continuing talking, yeah. So great job. But yes, I can certainly drink my water in front of you, but I decided to kick myself off for a quick moment. Another housekeeping item, if you could check the private chat for me as I'm kind of introducing the next topic here. So as we've covered a lot, guys, make sure that you are, if you have questions, post them into chat. We'll address the appropriate questions and share with you guys. If we don't get to them, we can always have one-on-one conversations afterwards. But really, what I want to do is I want to really talk about what is a trust. Like, what are the components of a trust? It's funny, and I might be wrong, but I'm pretty sure that within the trust binder, there's a will. So
Yes.
you said that the will is a problem, but then there's also a will inside of the trust. So can you give us a little bit deeper dive into the trust itself? How does it work? Go ahead, fire away.
So the reason you need a will is if you don't get everything into the trust, the will, you'll go to probate and everything will pour into the trust. It's called a pour over will, and it pours over your assets into the trust. Also, your will is where you designate guardians for your children. So you will need a will in order to do that, because that's not taken care of as part of the kids. I mean, as part of the trust. You can control who takes care of your kids' money and how they distribute it, but they cannot control who gets guardianship, because that's a court process.
Okay.
Trusts, I've said this already, it's a bucket that you put your stuff in, and you design inside of that bucket who's getting things, how they're getting things, what accomplishments you want them to, maybe your kids, to achieve. If that person dies, then what? I have a clause I refer to as the potato salad clause. It really means remote contingent distribution. And what that says is that if all of the people that you've named die, where does your money go? So what
I thought it meant don't leave it in the sun for too long because it'll spoil.
Well, that's what I said. You went to a picnic and it went bad, and then where does it go from there?
Oh, got it. Like everybody ate the potato salad.
Yes,
I was on the right track then.
Yes,
okay,
exactly right. Everybody ate the potato salad and it went bad. So the other thing that in the trust is you can designate how you're declared incompetent. At least in my trust, I have a provision where I can say, if you do you want to be declared incompetent by 2 licensed physicians, or do you want to be declared incompetent by a panel of people that you trust and love and know that they're going to take good care of you and make the right decision? And the reason is doctors have a harder time handling temporary incapacity. You're in the hospital, you've had surgery, this happened to my grandma. She was out of it for 6 weeks. We were able to execute on the panel, and my mom was able to handle bringing her home, hiring home health care, paying her bills, and taking care of all those things.
Got it. Okay. So potato salad clause. That's a good example as Dianna's talking about, why use her, because she's thought through these things. And, go to, I won't quote a website, but a something.com that gives you, the free plug in your questions here.
Right.
Like there's no potato salad there. So, all right.
And 1 second. I'm so sorry.
No, please do what you got to do.
I'm having technical difficulties of my own.
No problem. I've taken you off the screen. So once you're back, then we'll
I'm
bring
back.
you. Okay. Well, then let's put you back on the screen. All right. Well, that handled that.
Yes.
You're a pro. You're a pro. I love it. All right. So I want to jump into a couple of questions. First of all, Shani asked a question, and she said, "What are your fees, Dianna?" So, Dianna, what are your fees?
The answer is, again, the favorite lawyer answer. It depends. So
Yeah.
I have base fees sometimes that I do, but I do offer discounts for first responders, teachers, and people involved in the medical industry like nurses and techs. And it depends on how many properties I'm dealing with. It depends on the complexity of what you want to do in your plan. And so what I do is I offer complimentary consultations and listen to your story about what your family situation is like, what your asset picture is like, and I will give you a quote at that time. And I charge on a flat fee basis so that there's no surprises. The fee is the fee. And if it takes twice as long as I anticipated it taking, bad on me. But and I don't charge for phone calls once the plan is done, unless that gets abused, which I had a client who called me like 5 times a day for months. And so I was like, this
Gotta
is
put a cap on that.
a little bit much.
I gotcha.
I don't know what you should use.
So what about revisions though? So you said, hey, you call me back, but hey, my uncle that was the person that I was going to have take care of my kids when I'm gone, he's gone. And now I need to rewrite that provision, or my kids are now old enough that I don't need to worry about their college education. And so is that are revisions common? Is that a whole start over and a whole fee all over again because you're starting from scratch? How does that work?
So it It depends. Um,
Fucker.
so when I do my plans, I make you go down 3 levels. You know,
Okay.
trustees, that's the manager of the trust. That's the person who takes over to handle the affairs. I say, okay, who do you want first? Okay, now they're gone. Now who? Okay, they're gone. Now who? So that if something happened, you have that in place. You don't have to come back for that.
Okay.
For my trusts, like my kids, I say if they graduate from college or turn a certain age, which is further out, then they get the first chunk of money. Well, if they graduate from college, I don't need to worry about that provision, but they're just going to age up into that. So we can design it so that they don't need to do a lot of revisions going forward. That said, you should review it every year at tax time. So I do a summary of my trust so they can read through it and say, you know what, I don't like that person anymore that's supposed to take care of my kids. I need to change that. And if they do need to make some revisions, then I charge hourly generally. And as far as how big of an amendment, I have some clients who they've have a falling out with their children, for example, and they want to disinherit them.
I have always wanted to say, write them out of the will. So that's what we're talking. Like, did they call you? Have you ever gotten that phone call, Dianna? I'm done with that kid. Write him out of the will.
Yes.
Oh my God. Can you record it next time it happens? Like change their
lot.
name, disguise their voice. But I want to hear a real life example. Okay.
So there's lots of families, then they have dynamics. And, you know, I can tell things are coming because generally they'll make some comments in the beginning and then, you know, we'll keep it that way. And then as time goes on, they start whittling it down. And what I do in those situations, which is answering that question, is I restate the trust. When you amend the trust, you get the original trust and all the different changes that are made along the way. When you restate a trust, it keeps the same trust name, but you get a whole new document. So they don't see all of the iterations that have gone on. And I have clients, they disinherit their son and re-put their son in on a fairly frequent basis. He's in, he's out, he's in, he's out. And so I restate their trust fairly regularly. Okay. So he'll never know he was out, and then he'll never know he was in.
Because but isn't that the fun of the reading of the estate plan? Again, I'm going back to the movies.
A myth. That's not true. That doesn't.
Oh, man, you're stealing all of the fun parts of all of this.
I know. So in California, we have a requirement that the trustee notify the beneficiaries at the time that the trust becomes irrevocable, which is what happens when somebody dies. And with that, they can ask for a copy of the trust. You are entitled to a copy of the trust when you are a beneficiary if the trust is irrevocable or a person of interest. So I send out, generally when I do those notices, I send out the trust at the same time. And that's usually when things erupt.
When the drama happens, but there's nobody sitting around the mahogany table and the big high back chairs, you know, listening and, you know, holding their wife's hand, hoping that their name's going to get read and get more than just the doghouse.
Yeah.
Okay. Just in TV. All right. One more question, then we'll dive back. Nancy asked a question. Can a person on disability inherit a home without risking his or her disability SSI income?
Again, it depends on how it's done. And there's a law coming down. We're really close to where they're not going to be looking at assets. And a person who is on disability, usually the house is allowed in that. So there's that piece of it. But I have in my trust a special needs provision that, and I'll use, a real life scenario. When this client's parent passed away, they were going through cancer, and they were on assistance because they had it for a prolonged period of time, and it had impacted their ability to work. And if they had received the money directly from the parent, then they would have lost their benefits, and they were in the middle of fighting cancer yet again, and it would have impacted their treatment. So we were able to trigger the special needs trust provision, and the money and the assets were able to go into this special trust, and the client's child was able to maintain those assets. They weren't eligible for taking by the state because of how it was designed, and the family was able to utilize those to make the child's or make that person's supplement their lifestyle without impacting their income.
Got it. Okay. Go ahead.
But
I'm sorry.
generally, yes, they can. It just has to be done in a special way.
So I think you touched on this a little bit. I want to dive back into the big picture of trusts. How can trusts help me while I'm alive? Like, okay, I have a living trust. My wife and I have 3 kids. We designate where the kids are at, where the money goes if I'm gone, and if both of us pass, then who takes care of the kids, all of that kind of stuff. But aren't there provisions of the trust that help me out if something happens to me short of death? And how does that fit in?
Yes. So one of the questions earlier was about conservatorship.
Okay.
If you do not have anything in place and you become incompetent, a conservatorship will be necessary in most circumstances, absent any other documentation, in order to appoint somebody to handle your financial and medical affairs for you during your incapacity. So if you have a trust and you've designated individuals that take over while you're alive to handle your assets, and your assets are owned by the trust, and you have a power of attorney for assets that cannot be owned by the trust, such as retirement, those documents will generally prevent you from having to go through a conservatorship. And I also do healthcare documents as well to cover the medical side.
I think you just answered it, but I want to clarify. So that handles my financial affairs, but what about my medical decisions? So is there part of that that's part of the trust process?
Yes. So I look at a trust and estate plan like an inner tube. At the centerpiece is the trust, and that's kind of where you live. And then you have powers of attorney. You have all these other ancillary documents. On there is the HIPAA authorization to enable people to talk to the doctors. I use my dad as an example. I don't want my dad to make medical decisions for me because I would be tied up to a machine for all eternity. Yeah. But I do want him to be able to ask questions. So he's on my HIPAA, but he is not a decision maker on my healthcare power of attorney or my advance directive. I do 2 healthcare documents. I do a power of attorney, which is more focused on long-term care. It talks about arranging for, hospice or long-term care. It talks about rehabilitation. It talks about hiring and firing doctors, getting medical records so you can go get a specialist. That's handled in the healthcare power of attorney. The directive is more focused on end of life or acute care. That's where you get into the difficult questions, such as, are you okay with being removed from life support? Do you want to be an organ donor? Do you want to be buried or cremated? Are there any special things that you want to have happen if you are removed from life support? That's all covered in the directive.
Got it. And again, I think it's fair to say that some estate planning specialists cover just the middle, the inner tube, the center of the tube, and they say, hey, I've given you a trust, but you're missing the other layers. You're missing the rest of it. It's not, if you got a trust, it doesn't mean you got the other layers. It's a choice for the attorney, for the planner, for the person preparing the documents. There's no mandate that says, oh, a trust must come with all of these layers. It's your choice as the attorney. And I haven't asked you this question, but I'm hoping I know the right answer and don't lead us down a rabbit hole. But I think it's fair to say you probably almost refuse to not do those documents. Is that an accurate statement? Yeah. I mean, I can say, hey, Dianna, I don't need any of those things. Can I get the cheap version? Can I get, how much will I save if you just knock off a couple of those other documents? I can't.
And
I couldn't. Go ahead.
I won't do that because I am right now, or not right now. I just closed a probate not that long ago. The lady had a trust, but there was no will. And we had to go through probate because not everything was in the trust. And guess what? The will and the trust talked about different. There was no will, so the beneficiaries were different than what was in the trust. And
So that's where the designations, that's where the specialty, that's where the understanding of, hey, we're doing it right, because this isn't just a hey, I need one thing fixed. There are layers beyond what you don't know. You're not going to McDonald's and ordering a number 2.
The documents talk to each other, and you got to make sure, like my will says, talk to the trustee of the trust. My trust says, talk to the executor if there's one needed. So there's different things going on so that they talk to each other. They work together. The power of attorney and the trust need to work together. There are certain powers that you can give somebody in a trust that is your power of attorney, but it has to explicitly say that, and your power of attorney has to explicitly talk about the trust. And if they don't do that, they're not going to work together. So
beautiful. Beautiful. We've got about 10 minutes left. I think this has been amazing. I'd love to hear from you. We've got, a dozen and a half people that are on here now. So if you, I'd love to just get a quick shout out and comments on what was the thing you liked the most. What did you pick up? What have you learned so far? Just to, make sure that we're on the right track. And obviously, if you have any questions about anything, make sure to post them now so that we can get to those before we finish. So Dianna, I want to skip down because we've covered a lot of stuff that we had kind of in our outline. And I want to get to a question that I get from a lot of my clients. And that is, John, I don't need a trust. I'm too young, and we can address that a little bit. But more importantly, my gosh, my parents need a trust. I will imagine that 5 or 6 people listening to this right now are like, Mom, you need to go join John's YouTube channel. Well, yes, Mom does need to do that. But Mom, you need to get a trust. And Mom's just doesn't want to talk about death, doesn't want to talk about what's going to happen. How do you help people through that when they don't want to address it? Or is it really, you can't do anything until they're ready to address it?
So I've had situations where the parents wouldn't discuss it with the kids, but the kids encouraged the parents to call me and just look at it. And it didn't involve the kids, but at least they knew somebody was looking at it. Another time when they wouldn't talk, they said, well, can I at least see it? And then the kids snuck it into me to look at, so I could tell them there was some issues here. Absent, if they don't want to talk about it, they're not comfortable with it, and they don't want to talk to anybody else about it, and they say they've done it, a lot of times what people will do is they'll tell stories. I've heard this happen, I heard this happen, and can we just, at least look at it? I want to make sure I can make the decisions for you when the time comes, or who, we want to know who's in charge so there's no issues. And again, if they won't talk and they won't give it up, then a lot of times there's not a lot you can do, and then you deal with a mess at the end. I know that's awful, but everybody has the right to how they want to handle their affairs. And some people, I've literally had people sit across from me that say, I don't care. That's their problem. And I'm like, it's okay. There's nothing I can do to help you if you don't care. So
somebody had asked if we could get Dianna's contact information. So we've got it as big as we possibly can right there. So check out her contact information. And Dianna, I didn't ask you this question specifically, but I think it goes into this conversation. I've talked to clients who have said, hey, I am part of a blended family, or my parents are part of a blended family. And, Mom thinks this needs to happen, and Dad thinks this needs to happen, and nobody wants to, hurt the other person's kids, but they also want to take care of their own. And that's a thing. Like, how do you navigate that?
So, I do a lot of blended families. That's, that's a good amount of my clientele. And it's delicate. And, everybody has, if it's community property, they each have half that they can give away. So at some point I just say, what do you want to do with your half, or what do you want to do with your separate property? So sometimes it's a mixture of each of them have their own trust if they haven't blended their assets, but if they've blended everything and it's all community, then we figure out what are you going to do with your respective halves. And you can design the trust where the surviving spouse cannot amend what you want to do with your portion of the trust, so that they have to follow rules that are compliant with, to make sure that their money doesn't get skewed away from their children. So that's a possibility. And I always throw up, the scenarios where I'm like, if you don't want to lose all your control, but you have to understand you're going to lose, the protection for your children. So you have to try and find where that level is. And sometimes we just give the kids some money in the forefront when that parent dies, so that the surviving spouse has control over everything that's left. And then we don't have to worry about it. But you can design it. But that's a huge concern.
It is. I've also run into situations where maybe there is a blended family or a second marriage, whatever. And, one party has all the assets and the other party came into this marriage with no assets. They want to take care, like if the one with the assets dies first, they don't want to leave their spouse high and dry. But the truth is they don't want all their money going to that spouse. They want it to go to their family. How do you address that?
So that's that trust I was talking about. So that you can create a trust for the spouse that takes care of them during their lifetime, but puts restrictions on how much can be taken out and the parameters on which it can be taken out of. And then at the time of the surviving spouse's death, then it will go to the kids. So there is somebody overseeing it. And you can pick managers or trustees of the trust who oversee it that are watching both interests during that surviving spouse's lifetime.
Love it. All right. We got about 5 minutes left. I've got a good question here, so we'll dive into the question and then I'll come back. If we have more questions, please feel free to ask. By the way, I've gotten multiple likes on Facebook. Thank you guys for that. If you're watching on YouTube, give me a thumbs up on YouTube as well. That helps YouTube like this video, and I've gotten probably the best response in this on this live that I have in a while. So clearly this is hitting a nerve for a lot of people that this is important information. So to help this get promoted to more people, do me a favor and push that thumbs up button on YouTube for me. That would really help. All right, so let's go. I sound like a YouTuber, don't I? All right, so let's go with Randy's question. So Randy is purchasing a condo in Mexico, and ultimately I'm going to ask the second part of the question first. Can that be put into a trust? Like, can I put foreign assets into a trust?
This is what I always say. It doesn't matter what we say that a foreign country has to do with their property. What matters is what the foreign country who owns the property, where it sits. So I always tell my clients, I have clients who have property in Germany and in Mexico and Spain and Portugal. I have properties all over the world. The best course of action is to not include it in I will put a provision in your plan, but the best course of action is to get a plan in that country for that specific asset.
Got it.
Right now, I'm doing a probate for a client who's not a U.S. person, and it was devastating the result of the plan because it wasn't done under our laws; it was done under that other country's laws, and it did not give the impact, the protection that the family needed. So
love it. Love it. I appreciate that. Okay, so I'm gonna Anna, if you could put Dianna's contact information up, because I'm gonna ask a question that I don't think I prepared her for, but she'll crush this answer, and I'll guarantee you that the next 2 minutes, I'll promise you, the next 2 minutes will once again be the most highly watched 2 minutes. We're probably going to clip this out and put it on a separate video to send out, because here's the question I get all the time and I can't answer, and I'd love to use this as an answer because people ask it all the time. Okay, John, I don't have a trust. I don't have the assets to need a trust, but I know that there's a difference, especially in California, on how I hold title. I can hold it as community property. I can hold it as joint tenants, tenants in common. What the heck do those mean, and how do they work?
All right, I will start with tenants in common. The tenants in common is everybody owns an undivided interest in the property. Okay. So if somebody dies, a co-owner dies, their portion will either go through probate or it will go through their trust. It is not going to go to the remaining owners. I have a lot of clients who own things with family members or friends. It's tenants in common, and then their trust will get that piece. So there's that.
And even if you're married, if I own as a tenant in common with my spouse, then my part goes based on my will, which might go to my spouse, or if I have no will, it goes to probate and might go to my spouse, but my portion is my portion.
Right. And there could be some community property issues that come into play that will mucky that up a little bit, but generally speaking, yes. Tenants or joint tenants, it gives you survivorship. So whoever is the remaining joint tenant will own the property. So if you have two joint tenants or three, let's start with three joint tenants, one dies, then it's owned 50-50 by the remaining two joint tenants. And when the next joint tenant dies, the remaining joint tenant will own 100%. So that works well in avoiding probate. But again, I've had situations where they died together and then we're dealing with that. Then if you're married and the asset you deem a community asset is your joint asset, I recommend very, very strongly you hold it as community property with right of survivorship. And that has to do with that basis question that we talked about in the very beginning. Because if you own something as joint tenants and it was not community property, only the spouse, the person who died's half or portion steps up to fair market value, and the remaining part stays where it was. If you own an asset as community property, both spouses halves raise. So the surviving spouse has a asset with 100% basis increase. So that surviving spouse can utilize that new basis to either sell it, rent, do whatever they want to do with it. So it's really important if you're married. I think it's the wise way to go is community property with right of survivorship.
Is there community property without right of survivorship, or is community property always with?
No. So community property with right of survivorship is actually a fairly new, I'm saying new because it was around the time I became a lawyer, and that's 25 years ago, but
Fairly new.
But if it's just community property and there's some older deeds out there that it is that way, or it'll say even older, it'll say, John Smith and his wife, Jane Smith, you have to actually go to court and do a spousal petition to get that property put into the surviving spouse's name.
Got it. Okay. So definitely if you have an old deed, grandma and grandpa bought the house 50 years ago and nothing's changed since then, it would be in your best interest before something happens to grandma or grandpa, at the very least, to check and see how title is held and talk to an attorney, call Dianna and talk to her about that and see if, a trust is the right answer. But bottom line is that's something critical to make sure we're holding title appropriately.
Yes.
Perfect. Dianna, any parting thoughts?
No, I just, my attitude about planning is, some people are fearful of planning because they think it means something's going to happen. I look at it as you're planning so you don't have to worry about something happening. So when a client walked out of my office and said, "I'm free to live dangerously."
I guess so. Up the life insurance and we're good.
Exactly.
Dianna, I really appreciate your time today.
Thank you.
I do have one question. Geographically speaking, do people need to always drive to your office? You're located in Roseville. Tell me about that part.
I have clients all over the state, actually. So the pandemic did very little to change my business practice because I already had clients up and down the state of California. I cannot do things. So I have a lot of times people try to refer and clients who live in other states. I'm not licensed outside of California. So you need to be a California resident for me to help you. But I do a lot of it via Zoom if it is not in person. And then, but I do love in-person meetings. So I'm open to both.
Love it. And then the notary just happens, you would send it to them and they'd take it somewhere local to get notarized, because a trust does need to be notarized, correct?
Yes. Most of the documents need to get notarized. And so generally if they're up in the northern area of California, I will generally drive part of the way to meet them if they don't live local and bring a notary. If not, then I send them the documents with specific instructions, and I'm available the day of signing to make sure that they're signed properly.
Or you get to write off a trip to Disneyland.
Yeah. I've actually done that. So not the Disneyland part, but yeah, gone to Southern California a few times.
Absolutely. All right. Well, hey, thank you everybody for joining. Dianna, thank you so much. This was super educational, super valuable. Dianna's information at the top of the screen. Give her a call. I've worked with a lot of her clients. She's worked with a lot of my clients. She's absolutely amazing, and I trust her explicitly. Get it? I trust her explicitly. Did you like that? All right, guys, have an amazing day. We'll talk